Do you know the easiest way to build wealth in 2024 using ETFs? The world of investing can often seem complex and intimidating, filled with jargon and an overwhelming array of choices. However, there exists a straightforward, efficient path to wealth accumulation that is accessible to everyone, thanks to the innovation of exchange-traded funds, or ETFs. This essay will guide you through how a single ETF can become the cornerstone of your financial growth, simplifying your investing process while maximizing returns. The allure of ETFs lies in their simplicity and effectiveness. Unlike picking individual stocks or trying to time the market, investing in ETFs allows you to tap into the broad market's potential with a single purchase. This method not only reduces the stress and time involved in investment decision making, but also provides a robust framework for long-term wealth accumulation. In the following sections, we will explore what ETFs are, their inherent benefits, and why they represent a wise choice for both novice and experienced investors aiming to build their wealth. This journey will illuminate the path towards a more secure financial future, leveraging the power of ETFs to work in your favor. An exchange-traded fund, or ETF, is a type of investment fund that is traded on stock exchanges, much like stocks. An ETF holds assets such as stocks, commodities, or bonds, and generally operates with an arbitrage mechanism designed to keep it trading close to its net asset value, though deviations can occasionally occur. This makes ETFs highly accessible and easy to trade, similar to individual stocks. ETFs are designed to track the performance of a specific index, sector, commodity, or other assets. For example, an ETF might track the S&P 500 index, providing investors with the return of the index minus a small fee. This allows investors to invest in a broad swath of the market without the need to buy all the individual components of the index, simplifying the investment process significantly. The structure of ETFs offers flexibility and ease of use. Investors can buy and sell ETFs throughout the trading day at market price, just like stocks. This real-time trading capability, combined with the diversified nature of ETFs, makes them an attractive option for many investors, particularly those looking for exposure to a wide range of assets through a single transaction. Investing in ETFs comes with a myriad of benefits that make them an appealing choice for individuals looking to build wealth. First and foremost, ETFs provide instant diversification. By owning an ETF, you are essentially investing in a basket of assets. This spread of investments helps mitigate risk, as your money isn't tied to the performance of a single company or asset. Another significant advantage is the cost-effectiveness of ETFs. They typically have lower expense ratios compared to mutual funds. This is because most ETFs are passively managed. Instead of trying to outperform the market, they aim to replicate the index they track. Lower management fees mean more of your money stays invested and compounds over time, which can lead to substantial growth in your investments. Lastly, ETFs are known for their tax efficiency. Due to their unique structure and the way transactions are executed within the fund, ETFs often incur fewer capital gains taxes than traditional mutual funds. This can have a notable impact on your investment returns over the long term. making ETFs not only a simple but also a smart choice for long-term wealth building. When considering ETFs and individual stocks, it's important to understand their fundamental differences. Individual stocks represent a share in a single company, making your investment highly dependent on the fortunes of that particular entity. This can lead to higher volatility and increased risk, especially if your knowledge of the company or its industry is limited. ETFs, on the other hand, offer a broader exposure. A single ETF can hold a diversified portfolio that includes hundreds or even thousands of stocks. This diversification reduces the risk associated with the poor performance of any single stock. For many investors, particularly those who are not experts in stock analysis, ETFs provide a safer, more stable investment option. Moreover, ETFs simplify the decision-making process. Instead of researching and analyzing dozens of companies to determine the best investments, you can achieve a balanced portfolio through a single transaction. This ease of access and simplicity make ETFs particularly attractive for new investors or those with limited time to dedicate to portfolio management. Diversification is often touted as one of the most important strategies in investing, and for good reason. It is the practice of spreading your investments across various assets to reduce risk. ETFs excel in providing this diversification. A single ETF can cover various sectors, regions, or asset classes which would be cumbersome and costly to replicate with individual stocks. For example, an international equity ETF provides exposure to markets around the world, allowing investors to benefit from growth in different economies without the need to analyze individual foreign stocks. This kind of diversification not only protects against country-specific risks, but also enhances the potential for returns, as different markets can perform well at different times. The simplicity of achieving such broad diversification through one ETF is particularly beneficial for individual investors. It eliminates the need for complex and time-consuming portfolio management while ensuring that your investments are spread across a wide array of assets, minimizing your overall risk. ETFs are not just about reducing risks, they also offer significant potential for long-term growth. By investing in an ETF, especially those that track major indices like the S&P 500 or the Nasdaq, you are essentially investing in the growth of the entire market or sectors of the economy. Over time, as the economy grows, so does the potential value of your investment. Historically, markets have shown an upward trend over the long term despite short-term fluctuations. By holding an ETF for an extended period, investors can capitalize on this general market growth. This passive investment strategy, often referred to as buy and hold, has been advocated by numerous financial experts as a method to build wealth steadily over time. Additionally, the reinvestment of dividends is a crucial factor in the growth potential of ETFs. Many ETFs reinvest dividends paid out by the underlying assets, which compounds the growth effect. Over years, this reinvestment can significantly increase the value of an ETF investment, demonstrating the power of compounding in wealth building. One of the most compelling reasons to invest in ETFs is their cost efficiency. ETFs typically have lower annual fees than actively managed funds because they are passively managed. These lower fees can make a significant difference in your investment returns over time. For instance, a 1% higher fee can reduce your final investment return by 20% over 20 years, assuming an average annual return of 7%. Moreover, the transaction costs associated with buying and selling ETFs are generally lower than those for buying and selling individual stocks. This is particularly true if you are building a diversified portfolio from scratch. With ETFs, you achieve diversification with fewer transactions, which means fewer transaction fees. Finally, the tax efficiency of ETFs also contributes to their cost efficiency. ETFs typically generate fewer capital gains distributions than mutual funds, thanks to the unique way they are structured and traded. This means lower capital gains taxes for you, further enhancing your investment returns over time. To illustrate the power of ETF investing, consider the case of the S&P 500 ETF. This ETF aims to track the performance of the S&P 500 index, which is composed of 500 of the largest companies listed on US stock exchanges. It is one of the most widely recognized indices globally and barometer for the US economy. Investors who put their money into the S&P 500 ETF benefit from the collective performance of top US companies without needing to analyze each stock. Over the past decades, the S&P 500 ETF has delivered solid returns, demonstrating the strength and resilience of the US market. For example, since its inception, the S&P 500 ETF has averaged an annual return of approximately 8 to 10%, including dividends. This case study underscores the simplicity and effectiveness of investing in an ETF. By simply purchasing shares in the S&P 500 ETF, investors gain exposure to a broad, diversified portfolio of high-performing companies. This strategy reduces risk and requires minimal effort, making it an excellent option for those looking to build wealth effortlessly. As we've explored throughout this essay, ETFs offer a simple, efficient, and effective pathway to building wealth. They provide the benefits of diversification, lower costs, and the potential for significant long-term growth. Whether you're a seasoned investor or just starting out, the single ETF strategy can be a powerful tool in your investment arsenal. If you're intrigued by the potential of ETFs, the next step is to further explore your options. Consider your financial goals, risk tolerance, and investment horizon, and look for an ETF that aligns with these factors. Many resources are available to help you make informed decisions, including financial advisors, investment platforms, and educational websites. We invite you to share your thoughts and experiences with ETF investing. Have you used ETFs as part of your investment strategy? What has been your experience? Engaging in discussions about investment strategies can provide new insights and help refine your approach to building wealth. Remember, the journey to financial security is ongoing, and staying informed is key to navigating it successfully.